now we're kicking off the afternoon program of this stage, and it's hard to have a conversation about crypto adoption without getting into the realm of payments. So for that, I would love you to help me welcome onto the stage this cracking panel. We have Daniel, product lead from Gnosis, and then we have Simon, the managing partner from AllUnity. We have Paul, Chief Marketing Officer at Paybis, Markus Mølleskov, Chief Regulatory and Compliance Officer? From Januar. And then we have Ariane, who is Director of Key Account Management Open Finance from Mastercard. Let's give them a warm welcome, guys.
Well, thank you very much. They've given us an enviable slot right after lunch when people's digestive tract is most active and their brains are apparently least active. So we're going to try and make this exciting and energetic today. I'm Paul. Very kind introductions from my colleague over there. What we're going to do in this session is we're going to have a debate. Okay? I know you guys have heard all of the, talking points. We like consensus, but we like debate even more. And I'm joined by a very esteemed panel of guests here today. Before we do, I'd like you to put up your hand if you feel that you understand the benefits of programmable money. Put your hand up if you do. Okay. Now, put your hand up if you feel like you would like to understand the benefits of programmable money even more. Okay, so we understand where the sort of pitch is, okay? Hopefully that's helpful for you guys. Now, I'm going to do an exercise with you guys to kick off. And the exercise is I want you to explain in one short sentence what programmable money is, as though you were doing it to a moderately intelligent 14-year-old. So no jargon, one sentence.
I would ask the 14-year-old girl to explain it to me. I think the young ones today know more about it than we actually do.
Okay.
Yeah, I did raise my hand. So.
I did too.
No, but I think the idea is that you can use smart contracts to program money, is to make them smart and do smart payments, payment routing, those kind of things. And that has a lot of use cases that we're not even capable of thinking of yet. Same as with the internet. Initially, when that came forward, the internet was just, you could read the newspaper online, you can listen to the radio online, those kind of things. But nobody could envision what we have today with Facebook, Twitter, all social media, everything, like the dominant use cases that we use the internet for today. Nothing could envision back in the late 90s. And I think it's going to be the same with programmable payment. I mean, we have an idea what it can do, but it's going to be the next generation that grew up with programmable payments that are going to come up with new crazy things to actually use it for.
Okay, make payments smarter, which very helpfully is actually our key message, one of our key messages.
Okay, what would I tell the 14-year-old? I would say, look, before Instagram, there used to be like physical photos. And if you wanted to show somebody a photo, you have to send it to him. And the money that we have is the physical photos. And the programmable money is the Instagram.
Yeah. So what I would tell a 14-year-old is probably that today, like, we build all kind of sophisticated systems, but when it comes to money, it always kind of, a little bit slower, a little bit more friction. And 14 years old, they live their whole life online, but the money part is less smooth online. But with programmable money, you can add that into any workflow and build any logic into it to make payment, more seamless and definitely smarter as well.
Okay, so make payments smarter, more seamless, and move away from photos back to Instagram. I want to put a statement out there, guys, and in the interest of debate and teasing out a little bit of controversy, I'm going to start with you, Ariane. Programmable money's been promised for a long time. Is there anything fundamentally and materially new here? Because I think you've got an interesting experience given your professional background.
Well, my professional background before Mastercard, so that's my only professional, is that actually I was a trader at Danske Bank, trading OTC products, where I actually traded non-deliverable forwards. So I would say that's the old-fashioned name on the new stablecoin, actually. That was to help clients secure the US dollar for some payments they had to do in development countries. But we weren't that digital at that time. We are now, so now it's a new name, but actually the same thing.
David, you lead product at Gnosis. What's your perspective on how materially new what we have now is versus what we had before, but also what does it enable us to do that we couldn't do before?
Yeah, and as Adrian said, like everything gets more digital to actually enable this. But I think there are a lot of flows today that could be made even more efficient with digital money. You could have like the typical delivery versus payment flow that we have in traditional financial market that could actually be like automatic. You have something tokenized, received, and that would trigger a payment. Those flows would be a lot more efficient with adoption of programmable money, and more tokenization of real-world asset would enable this even further in use cases where it's not used today.
And you have to forgive me. I watch an hour and a half of TikTok a day. My brain has literally turned to jelly. When we talk about tokenization of real-world assets, what fundamentally are we talking about? Like, what would be the kind of the way to explain it, not to a moderately intelligent 14-year-old, but someone who doesn't know?
No, it's simply a digital representation of something that exists in the world, but you have a token of that lives on some kind of blockchain. So it's just a digital representation of something in the real world. Ownership of it, like physically, maybe would have to be enforced somehow by, state like laws and like it is today. But in essence, it's a digital representation of something that exists in the real world.
Marcus, I hope you have a disagreeing point here.
Kind of. No, so the idea is that many people think that if you own a Bitcoin, you actually own it, but you don't hold the Bitcoin. It's just on the Bitcoin blockchain, it states that your wallet has control of that. So people often need to know that, the blockchain is actually just a ledger. So in the same way that we have a register of who owns which house and have a automotive register who owns which car, those kind of things, what we're actually doing when we're tokenizing financial assets is that we're putting who owns what shares or what buildings or whatever on a public ledger. So everybody can go and see who owns what. And then using programmable money, you can then go in and do deliverable payments where we can say, okay, now that this payment has moved from this wallet to that wallet, the ownership of that asset is updated in the ledger.
I think that's a very good explanation, and thank you very much for keeping it so simple and clear. Simon, what is hype and what is real when it comes to programmable money?
Yeah, I would start maybe with some more debate and then come to the question, if that's okay. Yeah, because I think it's fundamentally different from what we have seen in the market for payments. Yeah, literally fundamentally different. Not on the part of enabling instant payments. Instant payments are already there. Totally fine, yeah. Not on the 24/7. Could be done also without programmable money. But the programmability itself is completely new and highly, highly underestimated as a secondary order consequence. It's fundamentally different from what all we have seen in the financial space. And it's very simple because we have seen exactly that. That's why I used the analogy in other industries. Currently, the process of the payment is digital. The money is not. We have digitalized a process around payment that's very, very convenient, also fast, efficient, blah, blah, blah. What we cannot do is we cannot integrate it properly. We build thousands of bridges, but if you want to pay, you always jump somewhere else. You jump to your bank account, you jump to PayPal, you jump to the credit card network. You always jump somewhere else. Why? Because the product itself, the money itself is not digital. What does it mean if you have a digital product? it means the product is a piece of code. That has not been possible before. Money has not been a piece of code. With stablecoins as one example of programmable money, the money is embedded in a token. It is a piece of code, which means you can integrate it in the business processes directly. And we had tons of use cases already at banks years before where we talked about them, where the potential of these advancements is hugely immense and unforeseeable. I'll give you one specific example, or two. First example is, for example, today corporates do a lot of business with each other, for example, in the chemical industry. In the chemical industry, they, however, then put invoices against each other. Then somebody in the accounting team has to write the invoices, has to check if the account details are okay. Then the other person checks the account details, puts it in the bank account, makes the bank wire transfer. The other bank checks the bank account. The money has arrived. I can book it out. Total process takes 2.5 hours on each side for each company. And the total duration of the life cycle of this invoice is 100 days, roughly. As long as that is ongoing, that's an open position on the balance sheet for both, especially if they do business with each other, because it's counterfeiting each other. Let them integrate it with the stablecoin payments, where you say basically, as soon as they both accept the invoice on an SAP environment, it's being paid and booked. Each side saves 2.5 hours of personal effort in the accounting team, plus both have in the same hate business with each other. If there's a liquidity gap, you can model the liquidity gap and let somebody pay for it. But the process is hugely more efficient. Other example right now is payments for fueling or car charging. It's being done today, very cumbersome, still via like credit card interaction, each time individually, and especially not really working if you have a small charging time. So if, for example, think about induction charging up front. Somebody, a car driving on an induction panel, or even worse, the worst payment mechanism in car fueling is the fueling cards. I talked to Mercedes in 2018, and they said we have a 5% fraud rate with payments via fueling cards. And I was shocked. 5% fraud rate for a regularly used payment mechanism is huge. And the reason is very simple, because the truck drivers that fuel the trucks use the card to also fuel their cars. And you cannot prevent it. It's very simple. However, if the car itself can pay or the truck itself can pay and gets the money, this is not possible. So we put a wallet into the steering unit, the operational steering unit, like the computer of the truck, and then the truck can pay. Takes ages to integrate that, but that's payment being integrated into a native process.
So Simon, you're a stable coin maximalist, I'm going to put you as, and you've made a very sort of powerful advocacy of that. Daniel, yes. I'm looking at the people down here as well. It's very confusing because you're not sat in the same order. But Daniel, are you a stablecoin maximalist? Were you a sort of a more sort of moderate stablecoinist?
I would probably put myself somewhere in between, because I definitely like stablecoins, and I think they have huge potential and will definitely be very big part of the financial system going forward, but it doesn't necessarily have to be stablecoins. Like if there's another technology that's better, we should use that one. Doesn't have to be stablecoin. Could be cryptocurrencies, for example. Like it doesn't have to be state-backed money. Could be a non-stable coin, so just a coin, for sure. Like if that's the better form of money, could be Bitcoin, could be Ether or something else. That's the way we pay in 10, 20, 50 years from now.
How would you get over the risk that, in this case, a merchant, a vendor, whatever you want to call them, would have by holding more non-stable coins, let's call them, or more volatile cryptos?
Yeah, and I think that would have to be like a gradual shift, because if, like today, everyone pays their supplier in some fiat money, euro, dollar, or whatever fiat money they pay with, it would be a risk for them to hold something else because it could be a bit mismatch between in and outflows. But if they start paying their suppliers in a cryptocurrency, then it would be a risk for them to hold a stablecoin or a fiat because they don't know how they'll change against each other. And if you hold a currency with high inflation, for example, even if it's a fiat currency, that's high risk because you basically lose value just by holding it. And for them, maybe a stable coin or a cryptocurrency would be a less risky assets to hold. So it depends on the situation, not black and white every time, but I do definitely think stablecoins will play a massive role going forward, but it doesn't have to be it, but it's definitely a stepping stone to something else, and maybe that's more crypto native money.
So we have one stablecoin maximalist, one stablecoin moderate. There are over, I think this was it was either a Visa, or maybe a Mastercard figure, I can't quite remember. It's close to sort of 300, maybe 390 billion in transactions in stablecoins. Where do you guys sit on this kind of stablecoin spectrum?
Well, I'm not from the stablecoin department. I would say that. I'm from the open finance department, so I can... in open finance, we have a lot of data. We have account-to-account payments, so we can actually do a lot of the things that you can do with your multi-stable coins there for the merchants. I would say for me, we have gone into this, Mastercard have gone into buying BVNK Bank to be on the rails, but also, as I can see with stablecoin, you have to have something underlying to support the stablecoin. You have to mint the stablecoin, so you have to get some money in to make your stablecoin. And what I can see at the moment is that it's difficult to off-ramp if I wanted cash instead. So the possibilities I see at the moment, not for Mastercard, but is a stablecoin is good for use in the countries where the currency is not that stable. Where I can see as a merchant, why should I at this time make a euro stablecoin until we get more digitalized? I think it's still something very new, and it's going to take some time for merchants to adapt it. Like, that's also why we're sitting at Mastercard thinking of new things all the time. We have the cards, we have the open finance, we have all different kinds of payment rails. Now we are going into the stablecoin area as well. So yeah, but it takes a lot of time to get people's mindset to change. And the digitalization gets faster and faster now compared to just 10 years ago. Like I think in the future, maybe in 10 years' time, like we spoke about, I think each of one of us will have a digital wallet where we have all our things in this digital wallet that we just move around, either to a blockchain, to a bank, or anything like that.
So, Marcus, I want to bring you in here because I think there's some interesting perspectives being shared. I also want to throw in an additional question to you. From both a business and a retail or consumer perspective, are stablecoins the answer to get over, let's call it, crypto's broader trust deficit?
I think specifically for that, I think stablecoins could be like a gateway for having more people adopt crypto wallets and kind of get them introduced to the infrastructure. Besides that, and going back to the other question, I generally don't think that stablecoins is the answer to anything. I think stablecoins is a catalyst for adoption, for new use cases, tokenized finance, like programmable money, those kind of things. But I don't necessarily think that stablecoins as a concept is a answer in itself. I think it's the foundation that is needed for everything else to function.
What is the answer?
I mean, for me, I have a background in financial markets, and I am a trained economist. So for me, tokenized finance is really the end goal, the way I see it. That's why I joined crypto. I mean, in economics, we talk about the wealth of society, or GDP, as money times velocity. So say I have a 100 euro note and I go to a market fair, I can buy something from you with that 100 euro note, you can buy something from Simon can buy something from Daniel. Then we've created 400 euro worth of GDP using 100 euro note. in today's society, with the financial systems we have today, we are trading $2 trillion worth of shares on the US stock markets alone every single day. We are trading $5 trillion worth of bonds on US bond markets alone every single day. And they each have 2 and 5 days settlement. So that means with my €100 note, I can pay you, and you don't have to wait between 2 and 5 days before you can buy something from Simon. By tokenizing that and by using stablecoins or any other cryptocurrency to facilitate that atomic swap, we can compress that wait time from days to an hour. And that means that the velocity factor of the entire economic system that we are living in just goes through the roof, and economic prosperity gets released into society.
So you're a sort of an accidental Bitcoin maximalist in the stablecoin maximalist, in the sense that you see the opportunity to accelerate growth by accelerating the velocity of transactions.
Yes, but again, I would say it's not the stablecoins on its own. For me, it's the tokenization of financial assets. But I do see stablecoins as a needed catalyst, because even if we had a full tokenized financial system, but we still had to use SWIFT transfers to make the trades, you would have a trade with 2 legs, one being a robotic leg and another being a prosthetic leg, right? So you get, you can only go so far with the robotic leg without having the other part of the transaction also being a robotic leg. So we need to have that tokenized payments that allows for tokenized or on-chain trading of financial assets.
Interesting. So, guys, let's be honest. Euro stablecoins are never going to take off. I'm going to play devil's advocate. That's not what I believe. And most stablecoin transactions at the moment are just entrenching dollar hegemony. Is that a fair statement?
I would say the dollar hegemony is a fair statement. And that is something that we want to change. Yeah. I had 2 weeks ago a discussion with the president of the German Nationalbank. Yeah. And they were like, just by telling about multi-issuance, he was fully aware, because they discussed it in the ECB Council a week ago with Christine Lagarde. So the topic is now finally on the top priority list. Why? Because in this space, in this room, how we do business, the market is right now already dollarized. That's just the truth. That's nobody talking about. Now, as an economist, and I think, but also all of us, or most of us as citizens here within Europe, do we want that? Do we want a dollarized market where we and our economic and social welfare is dependent on the monetary policy of the United States? Me not, personally. Yeah.
Why don't you want that?
well, the president of the Bundesbank said he mentioned Dunning-Kruger effect without mentioning names of presidents on which decisions I don't want to be dependent on. But that's a completely different discussion, maybe. Yeah. So our point is rather, are the euro stablecoins thriving right now? No. Is all the volume in the market bought? Yes. Why? Because we still allow, out of pragmatism or just unknowledge or whatsoever, that we get dollarized, because market liquidity in US dollar stablecoins is cheaper, because unregulated and regulated US dollar stablecoins get mixed up, and it's just cheaper to use the deep liquidity of the unregulated and also the yields of the unregulated stablecoins. So personal benefit, but society-wise, very, very difficult. And we rather push for providing autonomy of the underlying, which is at first the euro. But that's why we launched also a Swiss franc-based stablecoin, and that is why we're going to launch a Swedish krona stablecoin. Yeah?
You heard it here first, guys.
Yeah. So freshly announced, we will launch a Swedish krona stablecoin. Not telling too much, and hope nobody quoted me on that, but probably next month already. Yeah. So we're just gonna push it. Yeah. Will it be like taking off with 1 billion volume within a year? Probably not, to be honest and fair. Yeah. But hey, we want to push it into the market, and we believe, especially like coming after, there are tons of use cases which could be enabled by that. Yeah.
Let me ask well, first of all, let's go to Daniel, but I want to ask a question of the broader panel. Let's get your perspective, Daniel, but also prediction. You've got, the launch of new euro currency-based stablecoins and euro stablecoins as well. How long do you give it before actually we're sort of getting parity with use of US stablecoins versus euro ones?
In Europe, it can happen. Like overall, I don't think it will happen unless the European economy gets bigger than the US economy and takes over as the global reserve.
We've got more people. We've got 550 million people in Europe.
Yeah, but not the bigger economy.
Fair.
I think that's the more important part here. I think within Europe it should be possible, because like we shouldn't fight this hegemony of the US dollar by banning stable coins. We should have better options, and we should build the products that the 500 million people in Europe actually needs and pay their invoices, get their salary, and everything they do today. So we need to have something that is better and serves the needs of the people in Europe, and then they will use European stablecoins rather than US ones. I'm sure of that. But to take over
10
globally,
years, 5 years?
Yeah, 10 years.
Okay.
Yeah.
You're the one pumping these out. How long do you give it?
Well, let's see. Yeah? But I think within Europe, there is a good chance that we will have also euro stablecoins dominating US dollar stablecoins, and that's all I want to care about. I don't want to enter the US market and conquer the US. That's not my goal. Yeah? My goal is that we have within Europe European stablecoins. Yeah. Here, the playground simply right now is not fair, because USDC unregulated can pay interest, and we cannot. Yeah, so as long as they fully comply with regulation, happy to take them as they are, but right now they're just mixing it up. And so it's a really unfair market right now. I would say it's possible within 3 to 5 years. Yeah.
Bold prediction.
Yeah, but the reason is, still, we talked about tokenized economy and all the possible use cases. Who uses stablecoins right now? Within Europe, it's mainly crypto trading. Yeah, so it's it's become a large market, yes, but still it's a niche market. Yeah, and we are not even talking about who will actually use it. And I can tell the crypto traders, of course, they are happy to take whatever asset they can get. Yeah. So even if they off-list USDT because they have to, this is banned for a good reason, yeah, they still use offshore daughter companies that then still use it. Yeah, also nothing that nobody is talking about publicly, yeah, but that's just a fact and happening. But if you have real corporates, yeah, like real economy, no big corporate will go and take unregulated stablecoins where they don't even know how to book it into their accounts. Yeah, because you don't even know what it's worth, because you have to check how they depack every day. No treasury will do that. Yeah?
So let's, before I turn to Marcus and Ariane, let's take a quick straw poll. Put your hand up if you think we'll have parity of euro-based stablecoins. When I say parity, like sort of transactional volume, within 10 years. Okay, keep your hand up if you think it's within 5 years. Okay, a lot of optimists here. 3 years? Okay, there's 4 of you. Yeah. Okay, there you go. But I trust you. I trust you. You know more. I want to put a sort of a final devil's advocate question in front of you guys. One of the narratives around stablecoins at the moment is it's the bank killer. Right, we can in this stablecoin utopia, or in this programmable money utopia, we can do away with traditional fiat and banking rails and payment infrastructure because it removes friction, it can be cheaper, it's a lot more efficient as well. How true is that? And more importantly, let's assume that it is true, right? But the traditional financial institutions react and remove that friction and sort of increased speed of payment processing. Is there even an argument for stablecoins after that?
Well, first of all, I do think that in Nordics, where we have, SEPA Instant, we have mobile pay, we have, instant P2P payments and those kind of things. I think it's really difficult for stablecoins to get a foothold amongst retail because it's so fast and easy and cheap to do payments already. So there's not really a use for doing it. The cost-benefit analysis of switching from current infrastructure to new infrastructure, there's a cost related to that, especially like a perceptive cost of switching and having to learn a new system. And that cost is not, earned in or repaid with the benefits because they're almost the same because we already have instant payments today. It is mostly for, international payments, like global payments, potentially hedge funds that, we're talking about crypto trading using stablecoins and potentially once tokenized, we get more tokenized financial markets, we will have traditional institutional investors, family offices, pension funds, hedge funds, those kind of things, will likely start to use stablecoins to do on-chain trading because they can then start to get instant settlement on their trades instead of waiting 2 to 5 days. And then, as I said, cross-border payments, corporates who need a big, large corporate that needs to pay a vendor in Malaysia or something like that, they can also use stablecoins for sending that. And the question then becomes, do the vendor in Malaysia, are they okay with accepting a euro stablecoin, or do they insist on receiving a dollar stablecoin? Or potentially a non-backed currency like Bitcoin or Ethereum or something like that, that is not tied to the currency of the nation you're in, but has the same value globally and is not tied to anything, right?
So you, Marcus, you see utility, let's call it,
Yeah.
Even when and if the traditional financial institutions rails catch up, mainly based out of volatility. Is that a fair sort of summary of what you just said?
I don't think so.
Okay, I've misrepresented you. My apologies.
No. I think one thing is the adoption, and then another thing is the banks being afraid of losing their deposits, right? And coming from a banking background, I understand why the banks are afraid because they get a lot of free funding from their deposits.
Yes.
And right now, they're fighting very hard for the stablecoins not to be yielding because then they're afraid people will start holding stablecoins instead of holding deposits with the bank. And that makes sense. Personally, I think the solution to the problem. I just need to convince all the politicians that this is the solution, right?
Okay.
So, but now I'm going to share the proposal with you. So the proposal is that right now there's a legal requirement for stablecoin issuers to hold bank deposits and government bonds as collateral. If we allow the stablecoin issuers to also hold bank-issued bonds as collateral, the banks would be able to fund themselves using bank bonds instead of deposits. There would be less bank runs because you cannot just redeem a bank-issued bond. So they would reduce the risk by that. However, they would have to start paying an actual interest on their funding instead of the deposits. And they don't want that. But if the stablecoins are yielding, that payment goes from the banks to the holders, which means it goes from the profit of the banks out to society, out to regular people who are holding the stablecoins. And for me, that's a trade I'm willing to make.
Ariane, you have an interesting perspective, given you, again, your professional background. Banks are, shall we say, and this is a devil's advocate position, slowing down the movement of money internationally because, of course, you can do things with that money. And so a transaction which could take, in a stablecoin world, seconds or minutes, actually takes a lot longer because of those reasons. Does a stablecoin infrastructure future push banks to compress that time? And if so, what are the other use cases that stablecoin solves? A little bit like Marcus said.
I would say if the bank wants to, it could actually make a cross-border payment in 20 seconds. But it depends on how the process and the system works in the bank, how they earn the money. Because, like I also heard a lot of Bitcoin, stablecoin holder also trade for the underlying product to get some more interest. And I think that's the same the banks are doing. And that's how they earn the money. So what is the difference then? Because of a stablecoin holder, the underlying, he will trade for the underlying as well to earn some more. We have heard it from different kinds of blockchains doing the same. So yeah, I think the banks would have to start looking at it like we look at it with open finance, doing account-to-account transfer, like you said in the Scandinavia. I can't see the stablecoin because we can do instant SIBA payments account-to-account on those rails, and we can also use data to account owner verification, so we also know where the funds are coming from. So yeah, and we can do it instantly. So the Nordics, I think we are pretty good covered also with mobile pay and SWIFT and so on, instead of other kinds of rails. But yeah, I see the stablecoin being used also if we go into a country. But I also see more the US stablecoin than the European stablecoin. As if you go to another country outside of Europe, they rather have the US. And as you say, we don't like it, but the Fed is the one doing the financial world and has always done it. So I can remember when I was a trader, we were always waiting to the Fed coming out if they were going to lower or higher the interest or something like that. And that it involved the whole market. And we saw Thailand, we saw Soros. He showed us how he could move a whole market. So yeah.
We're getting towards the end of our time, and I want to put one final question to you guys, and it's a sort of a slightly quick-fire question. We love Mika, or Micah. Hopefully we have consensus on how to pronounce it. Where do you think either Micah has got things not quite right, or perhaps didn't go far enough? Let's start with you, Marcus.
Whether Mika has gone far enough, was that the question?
Yeah, what would you change if you had a magic wand about his implementation?
Oh, yes. So I do have an opinion on that.
Excellent.
So when we started out as a payment institution, we got what's called a limited payment institution license, which allows us to get off the ground. It took 3 months to get the license. We were not allowed to passport that license to any other EU country, so we were only allowed to take on Danish customers. And we had a volume cap for 3 million euros, so we could not process payments more than 3 million euro a month. Once we reached that limit, we had 3 months to submit a full license application. We are severely missing that in the MiCA regulation. There is no such thing as a limited CASP license, and that is a huge issue. Before MiCA, we had, several thousand VASPs that were small companies. Some of them were like 2 people and a website. I'm not saying that 2 18-year-olds on a website should be allowed to sell crypto, because there's a big difference between selling crypto and selling t-shirts, because crypto is financial assets, so it should be treated as a financial industry. But within the financial industry, there is such a thing as a limited license that can allow people to get licensed, to get off the ground with limited regulatory requirements, with limited fit and proper requirements for the management, those kind of things. But that does not exist for MiCA. That means that we've gone from several thousand MiCA or VASPs to less than 200 CASPs today. And that means that all of the small companies, all of the new startups, all the potential Coinbases of the future have just been killed. And we need to solve that to make sure that Europe is not going to be left behind by the rest of the world.
I've been told by my dear organizer friend that we have 1 minute left. So I'm going to allow you to come in quick fire on MiCA and final thoughts. 20 seconds each.
Yeah, I can take 10 to think about and then use the rest. No, no, it's very simple. Multi-issuance creates a gap with a not playing level field, yeah, and it destroys the European market for stablecoins by design. And by that, even though MiCA is a great regulation, but by providing these rabbit holes, it completely undermines itself, because the unregulated stablecoins from somewhere else are actually mixed up with a few regulated ones here in Europe, but actually it's the completely unregulated ones that dominate the market. where MiCA and the European Union don't have any kind of grasp on it.
Optimistic end. Daniel.
Yeah, like MiCA is definitely good to provide a unified framework, but we need to make sure we're not over-regulating to stay competitive, for sure.
Short and sweet. Thank you. Ariane.
Like I actually just said to Magnus, I think, yeah, sure, we have to do some regulations regarding this is something new. But I think that the EU are waiting to see what Gevalis comes out with their euro stablecoin before they're going to do a real regulation.
Well, guys, thank you so much. You've been provocative and inspiring, and I'd like to give you a round of applause.
Thank you so much. I think we're just going to pass this straight on.
Awesome.
To the next.
Thank you.
Let us see. And let me see. And Killian is removing one of the stools. That's perfect. Amazing. So staying within the realm of digital finance, digital money, we're going to have a conversation now that I personally have been looking forward to quite a bit. Courtney and I, we actually had a conversation yesterday because originally in the conference playbook, this panel was titled Shaping the Digital Economy, Central versus Commercial Banks in the Era of Digital Money. And the consensus among this brilliant panel was that the versus, just such a small two-letter word, creates a tension that is not going to be represented in the conversation here on stage. So help me give a warm round of applause for this panel. We have Hachem from the Danish National Bank. We have Ole from DNB, George from Swedbank, and then Courtney from Clius will be moderating. Let's give them all a big hand.
Hello, everyone. I'll give you the mic. I think I'm good here. So thanks for joining us for this panel. We're bringing together leaders from central banking, commercial banking, and digital finance infrastructure to explore how the architecture of money is evolving in increasingly tokenized and programmable financial environments. So we're going to exchange on the coexistence and intersection between central bank money, tokenized deposits, stablecoins, and next-generation settlement infrastructures, while exploring the operational, regulatory, and strategic implications for financial institutions and market infrastructures. We need to talk about interoperability, governance, and settlement safety, as well as how programmable finance is reshaping the future of payments. So, as tokenized finance moves from experimentation toward operational infrastructure, the relationship between public and private money is becoming a strategic question for the future of the financial system. I'm Courtney Williams from Clues Global Partners, where we support clients on strategy and technology architecture, designing the future financial market infrastructure. And I'll let each of the panelists present themselves and talk about their mission and purpose in the space, what they're doing. Hachem?
Great. Thank you, Courtney. So my name is Hachem Hassan. I work within the Danish Central Bank's Financial Stability Department, where for many, many years I've been focusing on digital assets, different types of money, but also how the next generation of financial market infrastructure would look like. Coming from a central bank and coming from financial stability focus, I focus on the risks that these different types of developments can introduce, but also how we should introduce them while having a safe and efficient system. Thank you.
Hi everyone, thanks for having me. I'm Ole Morten Sunde and I come from DNB. I work in emerging business, it's a division there. DNB is the largest bank in Norway. We are the largest settlement bank in the Norwegian kroner. In DNB I work in the intersection between product development and strategy. So more specifically, our purpose or mission is to position DNB for the future of the tokenized economy and bringing value to our clients in that development within a secure framework. I'm representing a commercial bank in this, but we are also working quite closely with the Norwegian Central Bank, So I've been working for a while in the space between the central bank and the commercial banks and how to create value in that intersection towards our clients. So hence, I'm really looking forward to this discussion.
Hi everyone, George Mansourati. I work for Swedbank. I sit in the group treasury department where I'm heading our capital steering team. And I have been for the past almost year working on our digital asset strategy and sort of what to do in this domain.
Awesome, thanks guys. So we're going to start by talking about the evolution of the monetary stack. The industry is increasingly moving beyond digital assets as an isolated topic toward broader questions around coexistence between multiple forms of money, programmable financial environments, and the evolution of the financial system architecture itself. So in that context, as tokenized finance evolves, are we simply digitizing existing forms of money, or are we actually redesigning how monetary ecosystems function altogether? Or otherwise, what does the future monetary stack actually look like once central bank money, stablecoins, tokenized deposits, and programmable settlement layers start to coexist at scale? You can take either one of those.
Maybe I could start. I don't think that we are simply replicating existing types of money, but also at the same time, I don't think that it's one-to-one with what we have today. And the reason I'm saying that is that, for example, with the emergence of new types of payment instruments, such as stablecoins, we are introducing new types of money that can have a role in the financial system. But at the same time, whatever kind of system we are introducing is not that new in terms of risks. So the same way we are addressing risks today, we will do so in the future. And the reason why I'm saying that is that today in the financial system, you have a tiered monetary system. You have central bank money that financial institutions are using to settle between each other. And then on top of that, you have different types of payment systems running around, mainly retail payment systems. And that tiered level, I believe, will still exist in the future. Whether you have stable coins, whether you have tokenized deposits, you will still need an anchor within that system, and there will always be central bank money. And the reason why I'm saying that is that you, as an institution that is settling large value transactions, would need the safest settlement asset. Today, that is central bank money. And it's not only a choice, it's also in the regulation that within these very important settlement systems, you have to use central bank money when you settle, if it's practically available. So in my view, the future system will not only, again, be a replication of the current, it will have new types of money, but you will still maintain the same level of structure in terms of institutions between, like interbank transactions would still need to have some kind of access to central bank money, and then stable coins, tokenized deposits, and traditional types of money will coexist in some way or fashion.
Interesting.
No surprise, I agree with you, Hachem, on that point, but I can take it more from a commercial angle. What we're actually essentially talking about is money, it's a utility, it's about trust. That's the foundation for money. And when asking or answering your question, Courtney, we are both digitizing and we are reshaping, basically at the same time. On the money side, we are basically taking deposits and we are making tokenized deposits. We're taking central bank money and we are making digital central bank money out of it. That's a new form, but money in nature is the same. That's a more direct route instead of inventing new trust models to the system. But we also should welcome in new instruments to this. But here is the foundation of things. What we are introducing now is programmability, as we heard from the previous panel. That's where we are start reframing things. And the coordination between. So we are always talking about these layers. They will coexist, but they will also co-work. Meaning taking back your layered approach here, Hachem. You have the central bank money in the bottom. Why? Because it gives unconditional finality. no settlement risk. That's the basis. When you build upon that, you would also like to have tokenized commercial money. Why? Because you want to be enable lending credit to the society to grow the economy. On the top level, you want to utilize the programmability. You want the stable coins in there because they are future ready for some agentic finance maybe or what. But that sits on top of it. So instead of reinventing everything, you should not throw out the baby with the bathwater. You should keep the elements that have been working and add on the new functionalities, the new innovation that comes with tokenization.
Thanks, and maybe no great surprise, but I agree with both Hachem and Ole here. Obviously, we will have a coexistence of different types of money. It's not that stablecoins will come in and and all of a sudden dominate everything. I think also, as Hachem alluded to, that I mean, even if we wouldn't have had regulatory regulations around which asset to settle systemically important transactions in, I think high denomination transactions would still be settled predominantly in central bank money, and I think that will hold true also in the future. To add something new to the debate here is that I think that at least in the medium term, what we will see is a sort of messiness in the monetary system, or like in terms of what money we use for what. Since we are introducing new forms of money, tokenized deposits, as Ole mentioned, stable coins, CBDCs, these are new instruments, and I think that everyone won't know exactly which instrument to use for what. That will need to sort of be ironed out during the few years to come.
Thanks a lot for all of those different points of view, which are very valuable contributions to the discussion. Considering the evolution of money on these different levels of the stack and all the new forms of money being introduced, what does that mean in terms of fragmentation and coordination and interoperability, making sure that we still have the right level of articulation between the different stacks, the different layers, and the different uses of money? As you just mentioned, George, in the beginning, well, now it's not necessarily clear which use cases are going to be most practical or most widely adopted for specific types of digital cash tomorrow, whether it's on the retail side or whether it's on the central bank side. We're going to keep thinking about that for a while because I think it's something the industry and the public sector as well needs to iron out a bit more. So another challenge in the same point of view, it's about the more technical side. So as financial infrastructure becomes increasingly tokenized, interconnected, what becomes the real challenge? Technology transformation or coordination between institutions, infrastructure, and jurisdictions? Otherwise, what does interoperability actually mean once multiple monetary systems, DLT infrastructures, and settlement environments begin operating simultaneously? I'll let Ole take this one to start.
Yeah, I can start. I don't think it's the technology is already there, and it's going to be solved. I'm pretty sure. What we are looking at is more a coordination problem or coordination problems. It's the coordination between different institutions. What will they adopt first of standards and in what timeline? Then you have the coordination of different infrastructures. What infrastructure to connect to? Whether it's Pontus, it's Kivalis, or it's DTC in the US. Third coordination issue is what jurisdiction and the lack of harmonization between different jurisdictions. So if you're doing a cross-border settlement, what kind of regulatory framework are you using? Which one is more favorable? And as we heard in the previous debate, to throw a little bit practical into this. This is actually what we're working with the central bank. We have the sandbox, the technical sandbox. That's kind of, it has to be there, right? But it's the working group and the coordination group and the reference group on top of that is really tackling the real challenges, working with the industry to define certain standards for the Norwegian infrastructure. And on top of that, we have to connect to the rest of the world. What kind of standards, regulatory frameworks, governance principles are we connecting to there? So that is why we are building a, I can get into that later, but that's why we are having an agnostic strategy. We are not taking a bet on any specific instrument, but we are there to find ways to connect.
Thanks.
I would say I agree very much with Ole on this one. And from my point of view, interoperability isn't just having an API layer and then you've solved it. Yes, that's maybe some of the technical interoperability. But as we move into a more mature application of DLT or other similar technologies, from my point of view, a central bank is and should be technology neutral. Where we're not risk neutral. We look at the risks, we assess them. We don't care which technology is being used. So this way I see interoperability is the way that it's always been. And that is we spent the past 20-something years on reducing fragmentation, trying to make things work together. So from my point of view, interoperability is, as Ole also mentioned, ensuring safe settlement finality, having the right governance in place, having the right regulation in place. It's all the boring stuff, but this is what's needed if you actually want to have a serious financial system up and running, or else you will have some basic use cases. And I think more importantly is also, I agree that we will see a messiness in the beginning, and that is because we need to make things work. We need to understand which functionalities are essential, and I think to make that work, you need standards. Standards are not super exciting, but they're super necessary. And so I think now that we have spent many years discussing DVP, atomic settlements, smart contract, and what else, these are basic functionalities that we understand well. The next step is to understand how do we actually make these different speak together in a way that is safe and efficient for everyone, while still ensuring that it's actually working and innovative. So I think from my point of view, this will be the next step for a tokenized DLT-based financial market infrastructure if it is to be developed further.
So we had some policy points of view. We talked about standards. We talked about technology. And then what about market adoption? What about international point of view, EU versus US or other geographies? It's not just articulating interoperability between European countries, but also internationally. You want to add anything, George?
First, before taking the international perspective, just again, building on what Hachem and Ole have already mentioned, but expressing it a bit differently, perhaps. I think tech-wise, I mean, we're very, advanced in relation to other, parts of society. And what I'm talking about, to be more concrete, is, lawmakers and regulators. They need to get some time to catch up, to get mature and comfortable with what is happening on the tech front. This is not sort of simple, easy stuff. We can't just redraw the entire system overnight and expect everything to work without collapsing. So, to mention a concrete example, we could see issuance of SEK-denominated bonds already today from a technical point of view. It's not that difficult, but we need to ensure that that regulations and laws are such that we can use the blockchain as the ledger. We don't need a centralized CSD to keep track of who owns what. But we need to let this mature. And then coming back to your question, Courtney, about the international perspective. All of this is happening in some sort of competition between different jurisdictions. So, I mean, we have the inter-European jurisdictions competing in a sense against each other, but even more obviously against the US. So we cannot just see what is happening here in isolation. We need to, of course, see and understand what is happening in the US, and we need to act accordingly to keep our competitiveness up.
Thanks for that. So we have, on the one hand, everything around standards, policy, governance, and coordination, and then we have all the transformation on the technology level, both on the public infrastructure side and on the private side. A lot of moving parts. Our next theme is around stablecoins, tokenized deposits, and the settlement layer, right? So we just mentioned before, we have different levels of settlement. So where do we see genuine institutional value emerging today around stablecoins and tokenized settlement? What parts of the market are still searching for a viable operating model? This is in the context of increasing and evolving adoption of stablecoins, as moving from crypto instruments to moving to becoming payment infrastructure. My other point of view I'd like to bring into this discussion is, as stablecoins are evolving from crypto instruments into settlement infrastructure, how does the relationship between commercial bank money and central bank money evolve?
So I'll start on that. So from my point of view, and I'm looking at sort of if we're discussing institutional adoption, where I see the action right now is unfortunately in the US, and where I see the action more concretely, even if it's from very low levels. I mean, I think two areas are of particular interest, I think, for institutions. And one of those is the tokenized money market funds. I mean, rather low, levels in terms of market cap or AUM, but growing rapidly and very, very interesting as a piece of the infrastructure puzzle. The second area that I think is very interesting is the repo market, also in the US. And there, as far as I understand, is that it's mostly on private chains where we see most of the action there, or like at least semi-private chains, let's say. And so, and then trying sort of extrapolating, and from where I stand at least, I think that the action that we will be seeing over the next few years will be on private chains rather than public chains for institutional adoption in size. So that's my view.
From a Norwegian or Nordic DNB perspective, there's not much clients banging on the door for a tokenized finance product as of now. We obviously expect that will change. Meanwhile, we are seeing the same as Swedbank is seeing, that there is a lot of adoption in the US, especially related to money market fund, as you said, and also the settlement with the stablecoin on that. You have the repo, intraday funding use cases where you save capital, but also I would want to add the collateral, the movement of collateral management is also another use case that is start picking up, that you can even now with the small scale see some commercial value from. There is also 24/7 treasury money movement use cases in this, but we are focused on security settlement here, so I might leave that out. So that's where we are seeing also the demand as of now. Locally, it's more some institutional demand after crypto custody and settlement of that. But I want to add an additional one actually, which we are also working on. Digital asset custody is coming up as a need, where you can store your tokenized security alongside your traditional assets. And you can utilize them as collateral and utilize them in the banking services as such. So that's a big one for us, and I think will be a big one in the future as well.
I think this is a tricky one because I don't think the answer is that straightforward. From a Danish point of view and from a Danish central bank point of view, we have been speaking to the market, and I think there exists this kind of chicken and egg problem, where if you ask the institutions, they will most likely answer, we don't see the demand yet, but we really want to do it. If you ask the central banks, should we have some kind of tokenized reserves, they say, well, technically, we don't care about the technology, we can do it, but we don't see the demand from the banks. So, and on the other hand, there is this question about, well, if the central bank issued reserves in a tokenized format, would the sector then jump on board and start issuing financial instruments to the clients, and would that then kick off the whole development? So maybe I can say a bit about how we are trying to tackle this issue, and that is maybe doing what we can do while the market might develop further. So the Danish central bank is very much integrated into the euro system in terms of infrastructure. We are part of the target services, which is the services that is offered on infrastructure level at the ECB, and because of that, we also have the Danish crown reserves within that infrastructure. And the ECB recently launched some initiatives, one called Pontes, which is a bridge between market DLTs. So imagine tokenized financial instruments on a DLT marketplace, being able to link into the systems of the ECB to settle transactions. We are involved in that and also looking into how we can ensure that the DKK settlement also in the future could happen. On the other hand, there is the more futuristic design approach, and that is, how would the future financial market look like? And we are also very much involved in that project. It's called Afshar, where we look into how would the Danish crown look into this future DLT-based ecosystem. But there is this real challenge that, at least in the Nordics, we're not seeing the demand yet, and some of the main use cases that I'm hearing is especially around collateral mobility. So being able to place collateral for a short period in time and then quickly move that around to other places.
So when you say you're not seeing demand, it's from capital markets. You're not seeing demand around market DLTs with new tokenized financial assets or applications. Right, okay. Well, thanks for all those perspectives, which really gives us a better picture of where we are and what's coming next. Our fourth theme and final theme of the panel is around programmable finance and future market infrastructure. As programmable finance evolves, capital markets, settlement, and liquidity environments may increasingly become software native on-chain. So as this happens, are we gradually moving toward an on-chain software native financial markets? Overall, what happens to the role of banks, market infrastructures, actors like Euroclear, Clearstream, custodians, etc., and even central bank money once financial logic becomes programmable? Is it going to become programmable at that level as well? I'd love to have your thoughts.
Yeah, okay. It's nice to bring in some perspectives here. We are not talking about very clear, explicit demand for these services today, but if you look at when I started in banking, we had this about 10 years ago. the competition was quite transparent in the Nordics. You had the large Nordic banks with their physical branches delivering banking services. Fast forward today, we are delivering banking services to third-party channels, digital third-party channels, and now in the future we will have the super apps of AI in the intersection to the customers. So these are developments the banking sector has been gone through all these years and will continue to enable. And that's important, the keyword, enable these services happening in the commerce. So we as a bank can connect and provide banking services in these value chain. And technically it might go from APIs to protocols to DLT based in the end there, but it will be an incremental journey. And back to our point earlier is that it has to be anchored in the bottom, but we should allow to utilize for these use cases. We are talking about use cases that will demand micropayment, for instance, right? You can't depend on the current legacy infrastructures in the bank to solve that today, but we are surely heading towards that. And that's our strategy in this, that we are building wallet infrastructure, custody services, so that we can, and bridges or connectivity. We are actually focusing on the orchestrating layer of the infrastructure. That's where our aim is, to connect to EU, to Pontus, to connect to the US, to DTC, to connect to Kivales when our clients ask for these kind of services. So that's where we need to head, but we cannot decide already where we are ending up. So that's why we need to have an agnostic approach to this and work on the infrastructure layer, at least from our side.
So, on the question, Courtney, of whether sort of what will happen to market players, infrastructure, banks, and so on, my view is that, at least for us banks, we have something that very, very few other market players have, and that is the trust of the public. So that's an asset that we have and that we hold very dearly, and that we intend to be stewards of going forward. I think that trust is something that that will sort of continue to sort of the public will continue to expect banks to do what banks have done for many years, and that is to manage credit risk, and it is to perform sort of liquidity transformation, right? That's not going to change. Some entity needs to do that, and banks are very well positioned to continue doing so, and that I think will continue to be true, hold true in the future. But continuing to build on that, I would say that for banks that dare to go into this new area, digital assets, and try different things, let go of initiatives that have failed, try new things again and again and again, I think that those institutions will be rewarded in the future. As long as they do it in a transparent and sort of trustworthy way, I think that they will be rewarded. And conversely, for institutions that don't, well, eventually they will be outcompeted, is my view.
Thanks. To finish up with Hachem.
So I would let the colleagues compete and maybe not speculate in who will become obsolete or which services will become obsolete. I think what our job is, and the way I see it, is that I'm looking into two scenarios if we as a central bank do not offer central bank money. The first scenario is that the financial market participants, meaning mainly banks, but also settlement systems, will look into a different settlement asset. Currently, that's mainly stablecoins and tokenized deposits, mainly stablecoins. I haven't seen many tokenized deposits yet. So the first scenario is that we see a lack of central bank money into these infrastructures. Therefore, there could be an alternative settlement asset, which is, in my opinion, much riskier. We don't want systemic transactions to happen in these types of money. And when I think it's just to translate what I'm saying is that when I say systemic is that if you have one part of the system being stressed, we don't want that stress to spread out to the rest of the system. So that's one risk that we as a central bank is very aware of. The other one is that if banks do not want to use stablecoins, then they won't move into this space. So we also kind of will hinder innovation. So the way we see it is that if the market is moving towards tokenized financial instruments, tokenized services, more infrastructures on DLTs, it's a natural step for central banks to follow that. So we don't pick the winners, we don't pick the technology, but what we do is we try to do it and help the industry do it in a safe manner. And this is basically a public good in terms of money, because we don't want these risks to spread out to the rest of the system. Hence, also why we are involved in the Pontus and Abia project, as mentioned earlier.
So there's real value in the central bank money remaining an anchor in the financial system. Okay, that's really great insights from all of you. My final question to close is, what do you think the industry is still underestimating about the future architecture of money? And I want to piggyback on what you just mentioned to make it a bit clearer for the audience as well, because we talk about private money and public money. We talk about central bank infrastructure, and this central bank infrastructure, when we talk about central bank money, we're talking about wholesale central bank money, which is used as a support to settle transactions, high volume transactions, capital markets transactions, right? And interbank payments as well. And then on the other side, we have retail money, which isn't used for the same purpose, right? And so the question is, when we have applications, financial applications such as DeFi, which are using stablecoins today, where these applications are actually replicating some, let's say, key services that you see in capital markets, how do we consider this, and when we redesign the future architecture of not just the money part, but the use of money in capital markets applications, when we know that central bank money is the anchor for settlement layer in capital markets applications because of specific regulations that we have in place to address those risks which Hachem just mentioned. So to close, please share your thoughts on what you think we're still underestimating about the future architecture of money.
Yeah, then I would say that we have a tendency to look backwards in order to project the future. And at some stage here, we are in between a shift. One example is that we have been going from T+5 settlements. Next year, T+1 will be something that we have to comply with. And but this is just a stop towards instant or a T+0 settlement. And meanwhile, we can't just keep opening our service hours and rely on the current legacy infrastructures that we have in place. The commercial use cases might not be viable as of now, and we cannot use business case terminologies to do the investments. We need to do the investment to position ourselves for this future. And in practice, it means always on infrastructures that we need to cater for. But it also needs to have always on regulatory compliance, always on liabilities. So in a world where we think that purely DeFi protocols can solve this, but at some time you want to call someone, but you cannot call the protocol. You want to call someone that has the liability that can provide you your money back when it's stolen from your account or what else. So my point is that the incumbent banks really need to see this shift and doing more transformational work on this than the incremental work on the backside, even though the market demand is quite incremental as of now.
Thanks a lot. We're going to have 20 seconds each for a last closing comment. And it's, what do you think, what is one thing you think the industry will see very differently in 5 years about everything we talked about? In 5 years, based on all the things we talked about, what is going to be totally different, or we're going to understand that we didn't understand it all?
When we stand in, then it will be 2031. Looking back, I think we will say that, oh my God, what, like the revolution that we will have gone through by then, considering where we are in the AI space, tied to programmable money, I think will be, similar, if not bigger, than what we saw standing in, the year of 2000, and if you would be, let's say, in 2005 and looking back, I mean, no one in 2000 would envisage Facebook, Instagram, Google, YouTube. So I think it's on the order of that. Yeah.
Very quick, very quick.
I think it will be on the interfaces, bank branches, third-party embedded banking, and you have the AI super apps of the world, and it's a completely different dynamic in the customer interaction layer of things.
And I think I'll be the boring one and maybe say that being here for 2 days and listening to the speed of things, people think things will develop, I think it will be much slower, at least within the financial infrastructure. I think you will be surprised how hard it will be to manage all stakeholders at the same time in transition.
Awesome. We want to say a big round of applause for our amazing panelists. Could we get one photo before we leave the stage?
Yes, absolutely.
Thanks.
Scoot on in, gentlemen. Let's
come on in
here. Let's do it. 1, 2, 3. Amazing. All eyes open. It looks good.
Perfect. Thank you.
Thank you so much. Let me take this one. Perfect. So welcoming on to the stage, now we're having a conversation on institutional market infrastructure. As the institutional adoption of digital assets, of cryptos, continues to mature, the demands of meeting a higher standard for the market infrastructure is likewise increasing, both in terms of liquidity, in terms of compliance and reliability. So sharing their insights on this, I would like to welcome to the stage Jon from Talos, Jennifer from CoinRoutes, Daniel from Bitpanda Enterprise, Dorian from Kraken, and Torbjørn from K33. Let's give them all a big hand. Let's see. You're missing your host. I can sit in. Let's see.
Jon?
The woman not owning crypto or digital assets. There we have it. Perfect.
Use the microphone.
Perfect.
Okay.
Go.
Cool. Thank you, everyone. I'm Jon Blankfield. I head up regulatory strategy for EMEA at Talos. I'm delighted to moderate this panel. So this afternoon we're talking about crypto market infrastructure, effectively the plumbing that lets institutions get involved in the crypto markets. And I think it's a generally interesting time for us to have this conversation. We see traditional financial institutions coming into the markets. We see regulatory frameworks bedding in all across the world. And then we also see the interoperability of traditional financial markets and crypto markets becoming something that was theoretical and is now a practical reality. So we've got an excellent panel. I'm really interested to see what they have to say. I'd like them to take 30 seconds to introduce themselves, maybe starting with Torbjørn.
Yeah, thanks. So I'm Torbjørn, the CEO of K33. We are an exchange for investors, for wealth managers, for businesses, offering, of course, buying, selling, and storing, market research, lending, and expanding with asset management services. So targeting the private wealth segment.
Straightforward. So hi, my name is Dorian. I represent Kraken here today. So to put it simple, we have been one of the oldest exchanges still in town. In crypto years, we're probably the old dog in the room. I don't know if some of you still do not have an account. This is the occasion. And I'll be your rep for Northern Europe in general.
Hello everyone, Januar Elsawey. I'm Global Head of Partnerships at Bitpanda Enterprise. At Bitpanda Enterprise, we specialize in Tier 1, Tier 2 neobank infrastructure. Similar to my colleague here, we've been around a very long time as well.
We're older.
And yeah, very much looking forward to having a discussion today on the infrastructure and institutions.
Hi everyone, I'm Jennifer Shaughnessy and I'm the CRO of CoinRoutes, and we specialize in execution, portfolio management, and risk controls, and connect to 60 different venues.
Cool. We had a great gang here. So I'd like to start with the idea of convergence. And I mentioned in the intro about TradFi and crypto markets coming together. So Torbjørn, maybe we can start with you. So are traditional institutions coming to crypto, or is crypto reshaping to become more like TradFi? What's your perspective?
I think what we've seen so far has mainly been financial institutions lifting crypto into their world, right? So, I mean, obviously, securitization of Bitcoin in the form of ETFs has been way more successful to date than tokenization. However, looking ahead, I think this is about to change. We now see some of the largest financial institutions not only stopping at ETFs, they are also expanding with real on-chain services. And I think that's where the next frontier lies. So I think so far it's been a securitization game. Now the real fun happens. Now we as the real crypto players actually can start to offer the real rails, which is the blockchains.
And then, so Dorian, Kraken has Deutsche Börse as a strategic investor, and you now have X stocks, bringing tokenized equities to market. So you sit at that intersection too. Like, what's your perspective on this?
Well, first I would like to take a step back and just remember that the fact that we're just having this discussion is that we already won in some ways. I like because my banking colleagues are not on stage to contradict us. So that's nice. Well, you always need a bad guy in the room, so I'll be that one. That's fine. The thing is, when you look at it retrospectively, what we did was like cross a river to not be with the same traditional financial system that there was. And that's why people went to crypto in the first place. And we kind of burned the bridges at the beginning, but we realized that as we grew, we would never going to avoid this discussion. And now all these, I would say, interactions, you told merging, conversions, as you said. Well, this is taking place. So you mentioned our partnership with the Dutch Bourse, because essentially what we're trying to do is replicate what we are planning to do in the US. So we also have a partnership with NASDAQ through our backed finance, that's X stocks for you. X stocks, the idea is pretty simple. You have your tokenized versions of stocks. You can earn your dividends all on chain. You can move it to your own wallets. You can use it as collateral on DeFi. Don't tell that it comes from me. And that's not financial advice, by the way. Obviously, like you do whatever you want. But yeah, all these possibilities, all these like features that were just limited to a certain set of investors in the past, now it's open to any user, technically. And what we are wanting to push one step further in terms of conversions is to bring the actual stocks, so that's NASDAQ for you, and to have the actual tokenized version of the stocks that would give you, for example, voting rights, property rights, all the traditional rights that you have as a stock owner, but this time on-chain, so available, I think the first target is something like 5 days a week, 24/7, and essentially we can think about a world when it will be 7 days a week, 24/7. Like this is the end game, I would say. Now let's see how fast this is gonna become a reality, because we are already proceeding with the technical tests. But is it that much about the technicality of it, or is it more about like the fact that all these traditional financial markets have to readapt their ways and like stop considering that 9 a.m. is something really really important as a time of day or closing hour, etc.
Cool. And so we're seeing the infrastructure converge, but who's actually showing up to use it? And I think, Jennifer, you probably have some interesting insights here. So what are you seeing? Who's in the order flow who wasn't there before, and why are they showing up now?
It's a great question. In the last few years, we're seeing, TradFi firms such as Citadel setting up their own market-making teams. You've got, Goldman Sachs has a derivative desk. You've got Jamie Dimon saying that the bank needs its own blockchain. Jane Street tripled its holdings in 2024 to 110 billion in crypto. So I think these are, some major names, and in the coming years, they're just going to be investing more in the space.
That's great. And Daniel, so are the institutions you see approaching Bitpanda now, are they different to 2 years ago?
I think it's the same types of institutions, but I think the wants and needs are different now. I think initially, a couple years ago, in the institutional space, it wasn't fully formed in their minds yet. Is this a separate asset class? Does this sit in FIC? Does this sit in equities? Where does this sit in the bank's offering if it's institutional? Is it going to stay? Exactly. Where does it fit in the bank's institutional offering? When you look at a bank implementing digital assets generally, there are multiple areas they have to consider. Custody, liquidity, general infrastructure. And with our industry, it's quite a unique infrastructure. They can't use their standard custody setup. They can't use their standard infrastructure setup, but they want some efficiencies internally to be able to use that, not to have to build everything out completely differently. So you saw a lot of innovation teams set up over the last 5-10 years with different permission versions of blockchains. And now I think banks understand this asset class quite well. They realize they can't build everything themselves, and now they look for like a modular structure where they can have access to their own liquidity, for example, or maybe directly connect to exchanges such as Kraken or brokers such as Bitpanda, but then ask for the custody services, for example, from another provider.
Sure. And Torbjørn, looks like you have something to add.
Yeah, and I think what's been very cool to see is that there's basically two Trojan horses. First was ETFs, where they thought, well, actually, now we're just going to wrap it as a stock and list it, and it's going to be very safe and secure. But it also forced all of the market makers, all of the participants that you named, to actually start participating very actively in the real spot on-chain market as well, because that's where they hedge, that's where they get the kind of coins. I mean, BlackRock's ETFs still have to hold the Bitcoin on-chain. Yes, in a partnership with Coinbase, but still on-chain. So that kind of been a Trojan horse pulling TradFi closer and into the kind of the real crypto world. The other is stablecoins, extremely hot right now. But even if you just want to have a bank consortium stablecoin, if you're going to test it on a public chain, someone has to buy ETH or Solana or whatever chain you're building on to pay the gas fee. Then there's an auditor, there's an accountant, there's a lawyer that has to figure out how to deal with this. So I see like the convergence is kind of, it's almost like a Trojan horse where they pitched like, oh, forget about crypto, it's all about DLTs. That didn't play out, it didn't work out. Okay, maybe we can take crypto, we have to put it into this traditional trading, and then only to realize that forces TradFi into the crypto space.
And so from your perspective, does that mean we are losing something in the kind of TradFiification of crypto?
There's a real risk of that. The biggest risk I see right now is on right to self-custody, right? There is a risk that in the future, you would only be allowed to hold Bitcoins with a regulated institution. And if we end up there, we just reinvented a new version of gold or something. It's not the true revolution that is available here. And I think also a lot of regulation is trying to really block a lot of what is innovative and functioning well in crypto. I mean, travel rule is a mess, and it's directly contrary to the benefits of the blockchain.
Absolutely. And so the institutional demand is clearly there. I think all of you have been talking about that. Daniel, I wonder if I could direct the next one to you, which is, what do you see from institutions when they want to white label your product? Like, what are their requirements, operational resilience, regulatory, etc.? I wonder if you could expound on that.
Sure. I think there are two main areas where it's non-negotiable for them. So firstly, regulation, clearly. If you're not a regulated entity or you can't use your license to offer them the services and provisions, it's a no-go, which is a good thing because it matures the industry for us. Yeah, exactly. The other piece is security, right? They want SOC 2 Type 2 certification, etc. So these are the minimum requirements once you go through DD with the banks. Outside of that, what they want is a customizable solution, right? They don't just want out-the-box liquidity or out-the-box custody. Maybe for custody, they want it on-premise. They want to manage it themselves. Or at the beginning, they ask someone like us to manage it, and then they transition into being able to manage it themselves after a period of time.
And then, Jennifer, so from your perspective, when you talk to institutional clients, what are they asking for that the market hasn't yet delivered?
Well, what I see when a traditional finance firm looks at us for execution is I see a lot more on the due diligence side and a lot more time around that. And like you mentioned, SOC 2 audits, very important. Counterparty risk, who we are as a venue, they thoroughly check out CoinRoutes. Execution has to be very provable. So these types of firms, they don't accept trust me, bro. They want you to measure everything. TCA, they also, as far as the reporting side goes, very thorough reporting.
Absolutely. And so one of the things that I've been quite interested in recently is whether the liquidity is there in European markets. And so I'd like to take a closer look at what institutional execution in crypto markets in Europe looks like. So, Jennifer, again, you see institutional order flow across a wide range of venues. What does European crypto liquidity look like at an institutional level? Is it there? Is it sufficient? Is it fragmented? Is it on Talos?
Yeah, that's a good question. So, the way that we see European liquidity is, so they have to be pooled off, according to MiCA regulations, which does cause fragmentation. And it causes a lot of this liquidity to be a bit patchy. So it requires aggregation. Also, when you're trying to move serious size and you've got these pooled off liquidity pools, you can end up really moving the market on these euro-denominated pairs, especially if they're illiquid. So you need a system like ours, basically, for this type of liquidity.
Absolutely. So Torbjørn, obviously you're active in the European crypto markets. Are your institutional clients finding it difficult to get the execution quality they need? Is for similar reasons? Is the liquidity there? Is the depth there?
So I don't think the liquidity is in the European market. And the fiat rails are also really not great. So all the liquidity, or most of the liquidity, is in dollars and in the US. Yeah. And what we've invested a lot in K33 is optimizing the FX, both kind of rails. We're banking with tier 1 banks in Norway, which is a low risk jurisdiction and very well connected globally. It's kind of giving better settlements for our clients, but also really optimizing our FX execution, because we are not going to find liquidity, obviously not in the Nordic currencies or franc or pounds, but even in euro. The liquidity is not in euro. So we are sourcing in dollar, but then pairing that with superior FX execution, because it's not a native and deeply liquid euro market, at least not yet.
Makes sense. Sure.
I think to echo this point, especially in the crypto market specifically, if you have a very large order and you want to exit on euro rails, for example, most of the time it's a triangulation trade, right? It's going to always go in the most liquid markets in dollar, as was mentioned, and then it's going to come back out to euro, and you just have to manage the FX.
Makes sense. Dorian.
On this point specifically, so we have been the oldest having euro rails as an exchange since already like 2014 something. And the liquidity in euro is much lower than what you can expect from USD. But what is also true is that currently the institutional flows that we see from institutions in Europe allows us to do it, especially when you cope it with some OTC, and you do mostly OTC for these requests up to a certain level. And OTC is available for all institutional clients anytime. You get your own quote specifically, etc. In terms of execution, it's still very seamless, but it's actually better for institutions from my understanding, because especially when they come from TradFi, they have this habit of OTC much more than what we have as institutions, crypto native institutions, where they want to interact with the order book straight. They want to see like how they interact with the market. For TradFi institutions, it makes much more sense to communicate with us, get the quote, settle on a price, etc.
Just one
Of course.
piece. On the liquidity piece, if an institution wants to do a big block trade, as was mentioned, we've seen that they don't want to get involved in connecting to all the exchanges. Liquid exchanges like Kraken or Bitpanda or Binance, if you want other liquidity, they are not comfortable facing that as a counterparty. So they come to venues such as ourselves to be able to execute. We take on the counterparty risk on that side, and they get the liquidity. But I think that's where the most usable liquidity piece is from the businesses that we work in at the moment, as opposed to just managing the liquidity. The banks enjoy the fact that they can face a regulated entity and execute with almost unregulated levels of liquidity.
Okay. So the theme I'm hearing there is clients increasingly want things all in one place, right? And so you talked a little bit there about how Bitpanda is meeting that challenge, but maybe could you expand a little on that as well?
Sure. So let's talk liquidity, for example. So we connect to 20 plus exchanges, including Kraken, OTC desks, and other market makers. And then we give the client a blended price, right? From that standpoint, for them, liquidity depth is good. So that solves an issue for them to connect to 20 venues, fix or WebSocket connectivity, managing counterparty, leaving funds on the exchange. Some of them will do credit lines, but still there is some exposure of funds across these different venues. So it makes a lot more sense for capital efficiency for them to face one counterparty and have access to many. From a custody standpoint, again, similar to what I said earlier, they can build their own custody or they can have a solution which is customizable for them, and that's why at Bitpanda Enterprise we have a modular solution which allows them to take custody only, take custody and liquidity, or take the whole white label infrastructure.
Cool. And then, of course, Torbjørn.
I was just going to add, because on the one side you see decentralization, right, where in the private wealth segment we see the same, right, that they don't want to have accounts on a ton of different venues to have the full access. They want to have us as the broker serving that, whether that's lending, whether it's derivatives that we are developing now, or kind of the liquidity for a big trade. At the same time, we see the value chain fragmenting, because in the good old days, the exchange was the custodian and the market maker and had like everything in one player. Right now, we're seeing that we have clients that want to have their own custody or do custody with another kind of third party, which is not the K33 as custodian, but they still want to trade and execute with us. So I think we're going to see more of the structure from finance where these different roles get divided and not necessarily bundled together.
Okay, interesting. And some of that tallies in with kind of the more crypto approach to things where you have the decentralization, maybe the sort of, in some senses, fragmentation. But what you're saying is there are benefits to that as well as, you know, not over-centralizing. So I'd like to talk a little bit about tokenization of securities. We talked a little bit about X stocks earlier. It's obviously the big brand name in the space at the moment. And so the infrastructure underlying that is maturing, but I'm curious about the assets themselves. So tokenized securities are now real through things like X stocks. But what are the remaining obstacles? I'd like to maybe go to Dorian first, given I've mentioned X stocks 3 times.
So actually, the remaining obstacles for that are very clear. For now, there is no equivalence between these tokenized assets, tokenized stocks, and the stocks that you own on a broker traditionally, in terms of especially voting rights, property rights, etc. It's diluted, and your property rights are, I mean, acknowledgement of debt rights, let's say, are towards back finance, towards X stocks. So there is still some kind of intermediary, and that's why it's very important that the actual stock exchanges, and I'm not talking only about NASDAQ and Dutch bourse, because they understood it and they are already doing this, and also the New York Stock Exchange, by the way. So that they already understood this, but there are many, many stock exchanges in Europe, for example, that could perfectly take, be faster. They are smaller, they should be more adaptable, more. We won't say anything about the Nordics because I really feel the compliance vibe is particularly strong here. But and my idea is there is really an opportunity to be some kind of standard setter, like to create the standard that everybody will use afterwards. So it seems that NASDAQ and New York Stock Exchange are going to be that. Let's see what Europe does, because in the end we talked about a lot about MiCA throughout this entire conference. The reality is, if everything goes through as we see in the US, they will have a much clearer package to prepare this tokenized stocks equivalents and therefore have them liquid, because that's what we want. Like you talked once again about the inconvenience of this. So there are these different types of rights that you don't have yet. There are some things that are cool. As I said, like you get paid in dividends straight on chain. So you accumulate tokens straight. No need to go back to fiat. And the issue is liquidity for now, definitely.
Okay, perfect. And Jennifer, so from what you're seeing in terms of tokenization, which jurisdictions do you find are leading in the space? You know, we see developments obviously in Europe with Xstocks. We see in the US, there was recent SEC kind of moves to liberalize that regime. And in APAC, we see progress. But where do you see the biggest strides forwards coming?
As far as strides in regulation around Xstocks, you mean, or tokenization of real-world assets?
Yeah.
I think, I mean, we're seeing real-world assets on our, platform kind of in their early days, so we are offering them on Kraken, and we see that you guys have put a lot of volume through it. I would say 25 billion. Yeah, and I think in like 9 months it went from 2 to 25. So you're seeing, extreme, I would say, demand on it. We still see a bit of or we're anticipating some fragmentation. So we are offering multiple exchanges, though we do recommend Kraken for Xstocks. And yeah, I think that's the take that I can basically offer, just because I'm seeing it more from how traders are using it operationally.
Absolutely. And I think I'm interested in, and you'll forgive me for a regulatory question given my background, but I'm interested in Europe's regulatory choices and the impacts on institutions. So these things don't happen in a vacuum, and they're being shaped by regulation and constrained by regulation. We've recently seen, and sorry to bring up MiCA again, but we've seen a consultation by the EC recently on changes, proposed liberalization maybe of MiCA. Let's be generous. So I'd like to move on to kind of looking at these choices and what they mean for institutional business. And so Torbjørn, if I could go to you first. So in terms of MiCA, are you seeing it create a coherent European market?
No. I mean, MiCA is giving credibility to those who obtain the license. It's pulling up the ladder, so it's reducing competition and creates a barrier to entry and higher profits for those that are within. But it is a mess, right? I mean, it's interpreted different by every country within Europe. And it's a severe over-regulation. And what I mean about over-regulation is that this never-ending demand for writing down and documenting the documentation of the documentation. And it's like 75% of it has nothing to do about actually increasing security or client protection, but has to do about kind of ticking boxes in a new way. And I think it's blocking innovation. It's pushing all of the innovative projects out of Europe. And I think what you're going to get is a MiCA-regulated bridge that takes you on-chain, and then a non-MiCA-regulated kind of offshore ecosystem that you can access by going via the regulated bridges. But unfortunately, that pushes innovation away from Europe, I think.
Absolutely. And Daniel,
if I can just illustrate, because you described exactly the situation, what is happening. In Europe, we have only one crypto company native to Europe that crossed the 2 billion valuation bar. It's called Morpho. It's a DeFi project. It's not under MiCA. Is there a question there? I don't know. But exactly the situation is it.
Absolutely. And Daniel, so what are your institutional partners telling you about the problems they encounter with regulation, and how are you helping them solve those?
It's interesting because when MiCA came out, we assumed, at least internally, that, okay, this is a no-brainer now. If the bank is interested, regulation now is ticked. Mm-hmm. So as long as we have everything else in place, this should move quite quickly. What we very quickly realized was, even if MiCA is approved and we are regulated, we have 3 MiCA licenses, we're sitting with a bank, and then there's still questions from the compliance and legal and regulatory team. Is this possible? Is this legal for us to offer? Should we get our own? If we get our own, there are many things that we have to put in the application form. So now it's a whole new process for them. That's in the more advanced banks and countries. In the countries that haven't got any major companies operating with Mika, specifically homegrown from that country, we've seen a lot of hesitance in terms of needing approval from the central bank in that country, even though technically they don't. It's more a notification. But so, to your point, it's caused confusion, even though technically it was supposed to standardize across all of Europe. There has been some hesitancy. It's better now than when Mika first came into effect, so we are progressing, for sure. Baby steps. But eventually I think it will harmonize. And I think once you have the European countries that have no Mika-based businesses operating homegrown, once you have them there, then I think you'll see the standardization a lot more.
Okay, and I think what we're kind of seeing is a divergence really between, say, the EU, the US, to a lesser degree the UK, and APAC. And so, Dorian, I mean, we've talked about Mika being live. There's obviously recent developments on Clarity, you know, finally making it to the floor of the Senate. Let's see if we actually get any further than that. Fingers crossed we do. But where do you expect the US and the EU to be in, let's say, 3 years? I mean, it sounds like the message is very strong divergence, but I'm interested in whether you agree.
To be honest, this is a very personal question, so my answer will be just my opinion and not Kraken's take on the future, because this does not exist. But on my end, I would say that, the conversions, as you call it, will be much more seamless, because in the end, that's the end goal, is that when you will be trading on your traditional stock exchange broker, etc., you will be using blockchain technology, and that was the goal from the beginning. You will not know even that you're using that. The only indication will be that the markets will not be closed when you're trying to trade. So that's for that. But fundamentally, it's also about the perception. I think in Europe, we're still lagging behind in the sense that we have a lot of institutions who still believe the technology is not going to stay, which at this stage is very divergent from what we see in the US. But once again, there is a lot that is at stake right now. It's not decided. It's really a work in progress. And that's why you have all this, I would say, these expectations around what's happening in the US right now. Like they gave this estimate that there is about 6 times the level of volumes that are already in the ETFs that are waiting to be poured in Bitcoin especially, but let's say crypto markets in general, from institutions who still do not want to set plans and invest in crypto markets because they make plans for like 5-10 years. And if whatever they make as a plan right now gets contested later on by, let's say, for example, a new administration in the US that would be much less pro-crypto, then their whole long-term strategy goals would perish in the middle of their execution, and this is not a risk that they're entitled to take. So that's why right now, if we have this foreseeability in the US, the levels of liquidity and volume that we will see will be dramatically more important. Doesn't mean that it will be all at once, especially traditional TradFi institutions don't do that. They come there smoothly, they buy over time, they sell over time, etc. So yeah, that's my take for the 3 years.
Thank you. And then Jennifer, so you obviously serve clients globally. How do you see the divergence in regulatory regimes, and how does it affect how you develop the product?
Yeah, that's a great question. And like you mentioned, you know, Clarity passing Senate banking is very exciting a couple of weeks ago. I personally do think that we're going to see them kind of run in parallel until there's some sort of convergence on what will work, but I think that that's going to come in the future. And I think as of right now, the US is going to continue to stay in the lead around derivatives. I believe Mika still has some challenges and some friction around that, though Kraken may have solved derivatives. Are you offering, I think you're offering derivatives for European clients right now that's outside of, MiFID. So I think there are some workarounds, but basically the way that we're going to focus is by offering, you know, all of the centralized exchanges in one place. We're offering Hyperliquid, we're offering Lighter, we're offering Aster, we're offering all of the plumbing that works within different jurisdictions until then.
Great. Okay, and then I'd like to close by asking each panelist a question, with the same question, don't worry. So if you could change one thing to accelerate institutional adoption, what would it be? And maybe Jennifer, since you got the mic, you start.
All right, good question. I think the execution piece is solved, and portfolio management, risk controls have become a lot more robust in the last year or so. Where I think the new frontiers are is cross-exchange settlement, cross-exchange margin, frictionless lending. This is I think the new frontiers to focus on for institutions that want to trade crypto.
Daniel.
I think it's going to be a capital efficiency play. So some form of prime. Bitpanda is also offering, Bitpanda Enterprise offers a prime product where effectively clients have a credit line, institutional clients have a credit line settle end of day. I think this will get them more used to what it looks like in the traditional markets. And as you increase capital efficiency, the P&L opportunity gets greater, and I think this will accelerate adoption for us.
Great. Dorian.
So I'm going to take this exercise as a thought process. So go with me because it's going to require a bit of imagination. I would like the fractional reserve of banks to be removed as a possibility, so that they would not use their crazy powerful lobbies to prevent competition from entering the space that we're all in, especially regarding stablecoin rewards, interests, etc. Because what's happening behind the stage is pretty simple. Any $1 USD that is brought to USDC means they are losing something like $9 on the stock exchange. So you perfectly see that if they just have 5%, of deposits moving from their USD balance to stable coins, they lose a massive amount of capital that they do not have the backup for. And that's why there was actually a solution from one of the previous panels that was actually interesting. The bonds from banks that would make them able to self-finance. I don't think it still works with the fractional reserve model that we have right now, but I would like it to think that it could be removed, so all this pressure would go away and the competition could actually take place. Because right now, they settled on some kind of agreement in the US. So to give you the agreement that we have at the moment is that no passive action with the stable coins will grant you passive rewards. So there will not be any equivalence to what the banks are offering when you just pour your money on your deposit account and you get some interest rates. But there will be a possibility for active actions to bring you interest rates. So typically lending protocols, using DeFi protocols straight from centralized places, or deciding really to lend on the platform because we have all these credit lines, mechanism, margin pools, etc. So all this will be possible. That seems to be the agreement that stands right now at the moment. Let's see.
Thank you. And finally, Torbjørn.
Yeah, but I'll echo that point because I think, well, institutional adoption is happening. It's going to continue to happen, but it's going too slow. And the reason is very simple. It's not enough competition between institutions. Because if it were, they would be more willing to take the risk. Someone would actually embrace this faster to win more market. They're not doing it because they have these nice profits from the barriers to entry. It is a real cartel. Why are they afraid of stable coins offering yield? Because they're not competing against each other. If there was true competition between these players, those margins would have been kind of competed away. And it's the lack of competition in traditional finance, partially caused by over-regulation, that is blocking the appetite of embracing new opportunities, because it's easier to defend what is already there than for a small new player to kind of make the new future.
So, thank you all. So, 4 really different perspectives. Some common themes there. Infrastructure is maturing, but there's still a lot of work to do. Will you join me in saying thank you to our panel? And thank you for your attention.
Amazing. Thank you so much, guys. Let's see, John, will you bring the mic down? And then Mirella and Killian, perfect. Let's see, final session down here for today. You're in for a treat because more institutional capital is entering crypto than ever before. But winning the mandates takes more than pure market conviction. So help me welcome onto the stage. We have Marco Poblete, Regional Director at Nordics for Bitwise. And then we have Raj Pljasevic, Sales Lead at Lowtech. Let's give them all a big hand.
Super. Hello, everyone. How are you feeling?
Hey, guys.
Good to see you.
Well, thank you for having us. Shall we start with a quick intro?
Absolutely.
Very good. So my name is Rad Poljašević. I am the sales lead at Lowtech, and Lowtech is a market maker / data company.
Yeah, my name is Marco Poblete. I'm leading the Nordics for Bitwise. Bitwise is the world's largest specialized crypto asset manager. We were founded in 2017 and currently manage about $15 billion in client assets. Some of our owners include people like Stanley Druckenmiller and Kevin Warsh, and we've been specializing since the beginning in research about crypto assets and also on institutional allocators. So we work with sovereign wealth funds, family offices, hedge funds, RIAs, and endowments to give them exposure to digital assets.
Well, shall we maybe for a start define institutional crypto mandates?
Absolutely. So one of the things that it's used a lot, especially in places like this, is the word institutional. And I think that one of the key things here is just defining what institutional means. I can hear the word being used both for just banks, larger allocators, to more narrow definitions, such as pension funds, endowments, and sovereigns. And I think that what's different here is not only the size of the allocator, but also what's at stake. It's typically about people's pensions. It's about a country's balance sheet. It might be an endowment, which is a university's allocation entity. And because of that, it's not just about the size of the investments that matter, but also because of the investment, what the investment is going for. Ontario Teachers Fund is a famous institutional allocator who recently started investing and exposing themselves to Bitcoin ETFs. And besides being one of the largest institutional investors in the world, they also manage pension money for teachers in Canada. So it's both about what's at stake, but also the size of the investor.
I think what is maybe worth noting as well, kind of crypto has been for a very long time and probably still is a very retail-driven market. So I think, why do we want institutions in this market? Kind of what is it that they could bring that kind of retail is not really bringing to it?
Yeah, like different entities want it for different reasons. This is a very crypto-native type of event. Here we have a lot of people representing protocols, exchanges, and for that reason, people are interested in the market growing. If you're thinking your life in Bitcoin, one Bitcoin is going to be one Bitcoin, but in reality, what a lot of people in this industry care about is that its share of the market grows. That's why we're interested in institutional adoption, because if we look at the last 5 years, a large growth factor for the crypto industry as a whole, but specifically Bitcoin, has been the institutional entry into this market. It's been the introduction of crypto ETFs in the US, the growth of treasury companies, and the reality that today, for every one Bitcoin that is mined to our bots, this is driving the growth of the entire asset class.
I think it's also worth mentioning kind of that the investment horizons of institutional investors are usually way longer than for retail investors. And I think the Nordics have been also traditionally very retail driven, but you guys coming in had a great success in attracting institutional mandates. Can you give us a bit of, I guess, a Nordic view on the crypto market, I guess?
There's an interesting thing here, and something that we can be quite proud about if we are from the Nordics, is that this is the country actually where the exchange-traded crypto exposure was born. So in 2015, the first exchange-traded crypto exposure was approved by Nasdaq in Stockholm, and that became the ignition for an industry which is now over $200 billion. So it was at the time a small product listed on Nasdaq First North, a certificate, and that grew to become one of the most traded products at the time. And on the early days, you had folks like Mark Cuban opening up Swedish companies to buy Swedish ETPs through capital insurance accounts. So you had these very special type of product that people from all over the world saw that you can buy crypto on an exchange in Sweden, a regulated exchange. That has evolved to what is now one of the fastest growing ETF, the fastest growing ETF market in the world. Large asset managers from the traditional side, such as Morgan Stanley and BlackRock, when they launched their Bitcoin ETFs, besides being unique for them, it was not only a successful launch for a Bitcoin ETF, it was their most successful ETF launches in the history of both firms. So this is clearly having something on a global scale, but in Sweden, we have seen some absence on the institutional side until recently. And this is quite special because we have this duality where Sweden is per capita actually the world's most active and largest crypto investment market. About 20 to 25%, depending on the market rates, of the European crypto ETP market sits in Swedish investors' accounts. At the same time, we saw that about 100% almost of that was retail-driven or maybe some wholesale. So this has been an absence of institutional investors in crypto, and a natural next step for this market, for the Nordic region, for Sweden, is to start getting allocations from, in this case, the pension funds, the larger hedge funds, and the larger institutional community as a whole. And the reason why it hasn't been the case there have been divided opinions on why that has been. Some have been that they're just simply not interested in crypto assets, that they're just not interested to allocate. But we can maybe go into what those that
yes,
debate is.
so I mean, I think now we have established kind of what these mandates are, why we want them, but then I guess can they know how were you successful in getting? What do these people care about? Kind of why? What does it take for them to kind of allocate a pension capital, insurance endowments, etc., kind of into the crypto space?
Yeah. Bitwise recently listed in Stockholm, so we're an American firm from the beginning. We entered the Nordics in January of this year, listed on Nasdaq Stockholm, and fun fact is that Nasdaq was renovating at the time, so we actually had our bell ringing in this room. And one of the things that led Bitwise to focus on the Nordics and want to do a full market entry and establish locally here with a local team is that we didn't fully agree that institutions in the Nordics were not interested in digital assets, in crypto. We saw that there was in fact a lot of interest in the asset class, but there was a lot of concerns that couldn't be solved by any of the alternatives that existed. Something we heard a lot was that people were worried about which implications it could have if the counterparty would have some issues. It was also questions about how that counterparty would create or manage an institutional due diligence. And this is something that if you're not dealing with institutional allocators, these buy procurements. So the way it works is that you have a 12 to 18-month process where you first have to create enough interest for them to open an RFP and a request for proposal. But then during those months, you are maybe one or a few investment alternatives that they're looking to allocate within the sleeve that they have defined. And when it comes to the ticket sizes, just to start, it needs to be that you can absorb the amount that institutional investor is going to allocate. And then they start at around $100 million per ticket and go up from that. And you're not allowed to be, that ticket cannot be more than 10% of the fund's total size. So that's just one of the requirements that happen, but the way they come is actually quite different. It's everything from a very structural RFP process with a bunch of counterparties to, I had a hedge fund manager who, no, sorry, not hedge fund, a pension fund manager who manages about 8 billion, so it's a smaller $8 billion in assets, who sent me a WhatsApp list of 15 requirements. Yeah. Just these are the requirements, this track record, this liquidity, this Sharpie, this search, and almost like if you fulfill this, happy to speak. If not, please don't waste my time.
There was obviously, for a while in Europe, there was a break on crypto investment for pension funds based on ESG.
Yeah.
And kind of ESG was really preventing a lot because people were thinking, oh, Bitcoin, how much energy consumption, etc. So out of my experience, I know that a lot of pension funds have used their private equity sleeve, which, given the size of these pension funds, can still be up to $1 billion. It's amazing. Has this opened up? Are they now a bit freer in what they are allowed to invest? Has ESG kind of come out of the equation, or don't get asked these things anymore at all? Is it more about performance? How secure are the assets? Who are you? What's your track record? Give us a bit more there.
Around the time that AI investing became popular, then the ESG question sort of went out the window, and it differs from the US and the Nordics and Europe in general. In the US, most institutional allocations to Bitcoin sit inside something called the store of value sleeve. And this is a sleeve where you would put gold historically. 100% of it in gold is not unusual. But nowadays, when we're seeing that Bitcoin enters these store of value sleeves, it has about 10% allocation in that sleeve. And this is also why you might hear sometimes that where could the price of Bitcoin go? Well, we can look at the market that Bitcoin is trying to take. And we can look at the institutional investors who already allocated to Bitcoin. And from those sleeves, if gold does what gold has been doing the last 10 years, the next 10 years, then, and if Bitcoin remains in those portfolios and rebalances with that sleeve, and no new investments come into Bitcoin, which is unrealistic, but if no new investments come into Bitcoin, then arithmetically we're landing at about $1 million per Bitcoin. So that's one way you can think about it. In Europe, we're not putting, as an institutional investor, not putting Bitcoin in their store value sleeves. They rarely have that. They would put it in the private equity sleeve. Some would put it in more of a venture or tech sleeve, even though I would argue it's not really suitable in that sleeve. And we are much earlier in the process. Now recently, Canaccord, which is British wealth manager, just announced that they're going to start allocating to Bitcoin. But this is things that happened not 1 year, 6 months. This was 2 weeks ago. So it's happening as we speak. And here in the Nordics, it's the same. So our first entry to this market was to understand what was the reason why not a single institution had invested into digital assets or had an exposure to the asset class. And 9 out of 10 times it was about counterparty risk and lack of research. So they felt that we don't have enough research on this. We don't have a desk that's analyzing this asset class, and therefore we cannot allocate. So we cannot have an opinion on it. So that's what we've been doing. So at Bitwise we maintain a research team, about 30 people ranging from PhDs to professors that publish 3-4 reports on a weekly basis on digital assets. And this is ranging from more deep dives into the academic aspects of quantum computing to more portfolio theory or shorter espressos, if you will, of information from our CIO, Matt Hugen. And this is used by a lot of investment advisors, by a lot of CIOs. And we have learned that this is a good way to make them familiar with the asset class, understand how is this valued, how can I understand the drivers. I spoke just a few hours ago with this pension fund CIO who said, sure, I see the return profile, I see the Greeks, but that's not the thing that I care about. I care about the fundamentals.
I was just about to ask, have you seen there like a driver what gets them into crypto? Is it really they don't want to miss out on an asset class that could potentially explode? Is it more like a real conviction that they have after? Is it like really a defensive move or more of an offensive move? What do you think is driving that?
There is the unison. So in the wholesale segment, which we separate from institutional, we call wholesale is what we call a family office, for instance. There would be a wholesale segment. They buy in large tickets, but they don't manage the money for your pension or something like that. They will allocate much more on an opportunistic basis, much more on a return basis. They will look at the maybe it doesn't covariate with the assets that they have in their portfolio already, so they like the effect it has on the long-term perspective. But this is not really how an institution will look at it. I'm surprised that I'm seeing mostly a fundamental narrative been growing up in the institutional side.
Do you see much risk in that kind of trend reversal there, or do you think the train has left the station? Kind of now we are really kind of getting, to a point where it's going to be just more and more people coming in, and then I guess when we see more and more money coming in, why is the price not rising and certain things? I'm happy to kind of also elaborate on that, kind of given we are a trading firm, but like maybe let's do the first part about kind of why. Do you think this is kind of just a one-way street now? There's more and more people coming in. Nothing really can stop this.
I think it's unlikely to see that this will revert to zero. I think what we are seeing is that we are much more moving away from the network drivers and network activity, that retail investors, momentum are driving the price of Bitcoin, and much more that the institutional demand is driving it long term. There are these mega trends, and those are the ones that these allocators are buying into or not. One of them is the mega trend around tokenization. One of them is a mega trend about stablecoins, which is a form of tokenization. The other one is about agentic trading and agentic AI. All of these, both you have to either believe in the mega trend as a concept and its importance for the world in the future, or you have to buy in on the idea that this has an effect on one or multiple digital assets. So that's what's driving these a surprisingly large amount of institutional investors into the asset class. Then once they bought in, that's the next step. Okay, where do I allocate? Do I buy spot? Do I buy ETF? Do I buy active fund, passive, AIF, SMA? There's so many different ways to expose yourself to your digital assets. And what we've seen is that this have moved to largely be two winning vehicles, one being ETFs and ETPs, the other one being treasury companies. So if we look at the Norwegian sovereign wealth fund, the oil fund, they have a 1% exposure to Bitcoin, but they have that through treasury companies, largely strategy. And this was actually a sort of friendly debate between sovereigns on what is the best way to expose yourself to Bitcoin. And there was a disagreement between another sovereign wealth fund, Mubadala in Abu Dhabi, who felt that ETFs are better due to their always trade at NAV, whereas the equity and equity as an instrument felt safer for many, and also the potential to gain a premium from the NAV.
I guess also it's probably kind of quite difficult for Norway to kind of change the mandate without kind of asking Parliament, etc. So, and easier for Mubadala, right? So I think when we are talking about the volatility, maybe I guess kind of from our side as a trading company, I think we welcome institutional investors. The more people are involved in this market, the more stable we become. I think the crypto market being 24/7 is quite unique, because there are still some periods with very thin trading. Yeah. In these periods of very thin trading, you can actually move the market with non-significant size. I think recently our good friends from AllUnity reported that, for example, on Poly market, some of the BTC markets are being influenced by 8 different whales, just 8, really being able to kind of move the stuff there. So we, as a crypto community, should be welcoming of institutional investors. The more capital, the more traders, the more money is controlling the flow, the more stability we're going to have. You can kind of see it on equities, where the only volatility really comes if the man in the White House has a change of heart, but mostly it's the 401ks really kind of pushing, and then the productivity driving forward. So from our perspective, institutional investors are going to get us to nirvana ultimately, and create a market that is really worth with this. So looking forward 3 to 5 years, what do you see are the biggest trends? Kind of what is it that kind of, I mean, I know you probably can't tell us which products you're working on, but like, is there something that you as an organization are looking as the next big thing, or kind of something, or an area of crypto that is of very much interest for your organization?
Yeah, so one of the things that we're publicly communicated is that we think that the ETF business is at some point going to become obsolete. And this is, it says a lot because we're managing currently 15 billion in those, but we think that eventually at some point it's gonna move over to on-chain vault strategies, decentralized funds, and this is something we're already seeing in the US. So we think this might. Some people think this is something that's going to happen in the future, but already today we launched a 300 million fund with the Superstate on-chain a few weeks ago. We are moving more and more of our assets on-chain through vaults, different yield-generating strategies managed by the same team that are managing our active funds, our active SMAs in the US. So this is very experienced people. We bring in people from Millennium, from other places that manage our funds. And 10, 20 years from now, we think that most is going to be on-chain, simpler, faster, more efficient. But currently, the ETF is the preferred vehicle for an institutional investor. It's going to be that for a while. We try to offer both things. We're both active on the ETF side, and in the US, we've been fortunate enough to work with some of the largest investors in the world. If we look at the institutional investments into digital assets, you have right now the endowments, Harvard Endowment's single largest public holding is in Bitcoin ETFs. You have Michigan State Fund, Pennsylvania State Fund. You have Stanford, Yale, Princeton endowments. If we look in this part of the ocean, then we have a Liechtenstein sovereign wealth fund, Luxembourg sovereign wealth fund have 1% of their entire capital in Bitcoin ETFs, including Bitwise, and this is continuing. So the Nordic institutions are not seeing this, and we have seen a few movements into this now. Just last 2 weeks, the Swedish third AP fund did their first exposure to Bitcoin through the treasury strategy, but a very small one. And we are also been seeing this in Norway. It's a matter of time. A lot of these processes are already ongoing, but it takes a lot. So it's about what other institutions have allocated to this particular fund. What is the track record of the counterparty that you're going to invest in, the ETF? Have it survived other institutional due diligence, and how did it do then? How did it manage the 2022 and 2018 drawdowns, and then you must have existed then? All of these things are part of the due diligence process that you go through if you are working with institutional investors. And eventually, once the interesting part about institutional allocations into assets is first nothing, then everything. So very quickly, you might start seeing that this is the fastest growing part of crypto.
I mean, I personally couldn't agree more with you that the future of ETPs is really the vault business. It democratizes access. You don't need to have your broker give you access to a certain set of ETPs. You don't have to buy the ones that are just available. You can invest whenever you want. It's 24/7. So clearly the way forward. If there is something that I think people should take away from this conference and from how to approach the next year. Is there anything you want to give us as a closing remark here?
Necessarily that I think it's good to always look at things from a first principle global perspective. We sometimes, especially the people that are local here, have a very Nordic perspective on things. Unless it has happened to SEB and Nordea, it hasn't happened, But that's not really how the world works. There is a global competitive market, and the same goes with what's going on now with stablecoin and interest rates. Yes, we're not affected by directly from the Fed, but we are indirectly because it's a competitive market for rates. So I think that looking at things from that bigger perspective is going to be important going forward.
Excellent. We should all be interested in everything outside of our own home. Well, thank you for listening.
Amazing. Let's give them all a really
Thank you very much.
Thank you so much. I couldn't think of anyone better to wrap this this stage for this conference. So right now on the upstairs stage, we have a final fireside, and then we have closing remarks upstairs by Jacob, as CEO. And I know that you don't want to miss it. There's coffee, there's cake. Let's continue the conversation and head upstairs. Thank you, guys.